qualified charitable distributions, or QCDs, from IRAs. That is the subject of today's ActTech Trust and Estate Talk.
Welcome to ActTech Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers in the United States and around the globe. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. And now, our ActTech Fellow host with today's topic.
This is ActTech Fellow Margaret Van Houten from West Des Moines, Iowa. Financial professionals, tax advisors, and estate planners should understand qualified charitable distributions in depth to help clients maximize tax efficiency and charitable giving. ActTech Fellow Professor Christopher R. Hoyt from Kansas City, Missouri, is with us today to explain the key takeaways of QCDs and to help ensure the continued effectiveness of this tax-efficient way for individuals aged 70 and a half or older to process gifts to qualified charities. Welcome, Chris.
Thank you, Margaret. It's great to be with you. And as we do our planning here to save taxes, for a lot of us, the largest asset that we have is our retirement accounts. I did look at my 401k recently, which has turned into a 201k, but short of that, if I'm looking for anything to make a charitable gift with, I might want to use my retirement account. But really, your retirement account is the worst asset to use for most of your life, especially before age 59 and a half, because a distribution will be taxable income. But the key point to remember is that after the age of 70 and a half, an IRA, an individual retirement account, is the best asset to use for all of your charitable gifts. Don't make gifts with cash, stock, make your gifts from your IRA. So by way of background, the general rule is every distribution from a retirement plan account will be taxed to you. If, for example, I have a $1,000 distribution to my brother in Wisconsin and then a $3,000 distribution to a charity, $4,000 has left my account, I didn't get a penny. But the IRA administrator at the end of the year will tell me that I have $4,000 of taxable income. And I say, how come? Because I didn't get any of the money. It went to my brother, it went to a charity. And they said, well, what happened is every distribution from your retirement account is taxed to you because income is taxed to the person who earned it. We don't care who gets the checks. So that's the rule. And if I'm under the age of 59 and a half, I'll have a 10% penalty. But Congress created an exception for people over the age of 70 and a half. It's called a qualified charitable distribution. And so in that case, if $1,000 goes to my brother and $3,000 goes to charity, I will only have taxable income with $1,000 that went to my brother. I will not have to report as income the $3,000 that went to the charity. Now, I will not be entitled to an itemized charitable deduction of $3,000. But in general, reducing your gross income produces more tax benefits than getting an itemized deduction for charitable gifts. So what happens is I get this form at the end of the year, the 1099-R, and it says you have $4,000 of taxable income. I said, but you know that $3,000 went to the charity. But that's okay. We don't put any burden on the IRA administrators. They just issue this form. You have taxable income $4,000. The IRA owner has the responsibility to save the taxes on their own tax return. So for the lines for IRA distributions, there are two boxes. One box says total distributions. The second box says taxable distributions. So in the first box, I put down $4,000, which matches the number that I got on my 1099-R. But for taxable distributions, I would just put in $1,000. And I put three letters next to it. The three letters are QCD. That tells the IRS why I'm not paying tax on all $4,000. I'm just paying tax on the $1,000 that went to my brother. So to qualify, the IRA owner has to be over the age of 70 and a half. If I do this at age 68, I got $4,000 taxable income. The most you can exclude from your income in 2025 is $108,000. It's indexed for inflation. But the secret sauce here is that these IRA charitable gifts satisfy the required minimum distribution requirements from IRAs. And as most of you know, once you're 73 years old, you have to start taking distributions every year from your IRA. And maybe I have to take out $4,000. Now, there's some things that most people cannot do with that RMD. The first $4,000 out of your IRA cannot be rolled over to another IRA. The first $4,000, the RMD, if my RMD is $4,000, cannot be used for Roth conversion. The only thing you can do with your requirement distribution is give it to charity. And so if my RMD was $4,000, I cut my taxable income down to just one. So it's kind of a pain to go to the IRA administrator and say, cut a check to charity for $3,000. My brother won. Who should do it? You should only do it if you save taxes. And so the people who win with this law are donors who take the standard deduction. The charitable deduction is an itemized deduction. And so unless you itemize, you can't deduct your charitable gifts. So really, senior citizens with IRAs have it better than most people because only about 9% of taxpayers itemize. The other people are people who live in states where the state income tax laws don't permit a charitable deduction, such as Ohio, Massachusetts, where you can deduct it in your federal return, but you can't deduct on a state return. Other people who benefit are people who benefit if their income stays lower, like Medicare B premiums. If your income is over $100,000, just by $1, your Medicare B premiums go up by 40%. Married joints like $200,000. So by keeping your income lower, you can pay lower Medicare B premiums. And finally, the people who really will recommend this are the kids. Because if they have a choice between inheriting an IRA or inheriting stock, when they inherit an IRA, the distributions are taxable. But when they inherit stock, there's no income tax on the inheritance of stock, and the stock gets a step up in basis. So they'll say, parents, make your charitable gifts with an IRA. So there'll be more stock for us to inherit and less taxable income. So there are 6 legal requirements to qualify. First one is you have to be over the age of 70 and a half. The second is that this only applies to individual retirement accounts. So if you have a professor with a 403B or a worker with a 401k, they can't do this. They need to roll over some money to an IRA to take advantage of it. Third, there's a dollar limit of how much you can exclude from your income each year. Again, it's $108,000 in 2025. Now, one requirement is that the distribution from the IRA must be made directly from the IRA to the charity. And what that means is that the charity's name has to be on the IRA check. And so the best way to get this done is most IRA administrators will issue to your IRA clients an IRA checkbook. Once they're the age of 7.5 or 59.5 or something like that, they'll give you an IRA checkbook, and every check you write is a taxable distribution from your IRA. Dangerous things, but they're perfect for these charitable gifts. Because, when the charities send their thank you letters, thank you for your gift, they might not say, this was a gift from your IRA. And when you take those thank you letters to the CPA to do the tax return, they don't know it's an IRA gift. But if you have an IRA checkbook, then you give them a check register, and then they can look at that and make sure you get the benefit from all the gifts. I do want to warn you a little bit about IRA checkbooks. The IRA distributions are determined by when the IRA administrator issues the payment from the IRA account. And with an IRA checkbook, they won't know that until they receive the check. So people who have not taken out the required minimum distributions, one of the big mistakes they make is they give checks to their kids and grandkids in December. And if they're like my kids or grandkids are like me when I was a kid, they don't cash those checks right away. So be sure you take out your required minimum distributions earlier in the year and don't wait till December. The 5th requirement is that most charities qualify except for 3 that are the most fun. And the 3 that you cannot use this IRA exclusion for are a donor advised fund, your grant making private foundation, or a supporting organization, a 509(c)(3), Friends of the Hospital, and the like. Next requirement is that you can't get anything back, with one exception I'm going to share with you at the end, where the charity can make a big gift back to you. But to qualify for this, you can't use it for an event where you get a dinner or you're buying something at an auction. It has to make a complete gift. I'm making a complete charitable gift. And then the last requirement is the donor has to have a letter from the charity that the donor received no goods or services in exchange for the gift. So those are the requirements. Some technical things: you could pay a legally binding pledge with your IRA. You can't do that with your private foundation, but you can do it with your IRA. On a joint return, each spouse can take up to $108,000 from each spouse's IRA. And with IRA distributions, they have a default 10% withholding tax. You just say, don't do any withholding. Last one is if you inherit an IRA, can you use your inherited IRA to make these charitable gifts? And the IRS says that if you are a beneficiary of an inherited IRA and you, the beneficiary, are over the age of 7.5, you can make charitable gifts from the inherited IRA. But if you're, 50s, 60s, you can't do that with inherited IRA. The last thing to leave you with is that since 2023, charities can now give you back one major thing. And you can make a once-in-a-lifetime transfer to a charity up to $54,000 from your IRA and you can get back a lifetime annuity. Many large charities and universities issue what are called charitable gift annuities. And so if you're in your 70s, they might pay you like 7% a year for the rest of your life. So you can do this right now. It's only a once in a lifetime option. The maximum you can do is $54,000. But if you're making a gift to a university, the odds are they offer these gift annuities, and you can get a lifetime income stream for you and your spouse or your spouse. And that's it. It's a wonderful law. Again, for your clients who are in their 70s, 80s, and 90s, do not make charitable gifts with stock or mutual funds or even real estate if they have IRAs. When the kids inherit the IRA, they got taxable income. When the kids inherit the stock, mutual funds, and real estate, they get a step up in basis. And that's the way to do it.
Thank you, Chris, for that very informative presentation.
Thank you for listening to this episode of AgTech Trust and Estate Talk, the podcast series about wealth planning matters from the American College of Trust and Estate Counsel. To find an AgTech lawyer near you, visit actec.org. Please subscribe to this series and leave us a rating or a review.